Hello, this is Professor Hazara sitting in my office here in Valentine Hall. And anyway, what you completed for last week um, was one of the things I had you complete. Probably the most important thing was you did some extended ratios there, some extension of return on assets and return on shareholders' equity, and I think that's fairly understandable. That's even taught in accounting courses sometimes. But the more important thing you finished was the short form valuation that we did in class. And I believe that there was just a few, we were just a few dollars off there. I'm not sure where it was, but no big deal. I think I put up the sheet and we came to some price on Microsoft. It's all from Microsoft. Okay. And this is a very basic valuation. It's very too basic because you really don't break down the detail of financial statements to see where a company could change its revenue, let's say, or where a company could, what line item on a statement a company could change in order to change the stock price. I mean, they might cut costs. That may be one way to do it. One way to do it, cut fixed costs. You may look at revenue and say, well, they could increase some of their revenue in one of their segments, that type of thing. So we're going to do over the next couple of weeks, I think, a full valuation using full pro forma financial statements. I believe this is chapter 11 in the text, and I believe that's what I put on the syllabus. We may spend an extra week on this, but let's see. I think doing this well is very important. Everybody having some idea of how to do this. And you will see that a major part of this is building a pro forma statement of cash flows. Anyway, so you should have, or I will put up this worksheet, and you will have given me something similar to this. And then to the right, I have put in something called, this is from Microsoft. We'll use this. This is our model, so to speak. We're going to do full valuation, and I'm going to have maybe 4 videos on this. This first one, I'm just going to set it up for you, and then we'll work from there. Okay, and I like to do short form valuation because we actually are going to start by picking. At the beginning, we're going to pick off pieces of the short form valuation. And actually, we're going to use the latter part of it, the last part of the valuation, in our valuation here for the long form valuation. Okay, so let's start with inputs here. So let's write the word inputs. I'll just write the word inputs here. And we're going to assume once again that it's a two-stage model, basically. And we're going to use, basically, once again, assume it's a linear assumption, meaning that everything is sort of grows in a linear shape. Although when you do a full valuation, you can start changing those things. Okay, so let's go ahead. So I just cut and paste those from the short form valuation. Okay, now we're going to do, I'm going to set up the basics to facilitate our construction of the pro forma income statement and balance sheet in this ratio, in this worksheet. Okay, so what I'm going to do is actually go over to the actual income statement, which is fortunately pretty simple, and the balance sheet too. And I'm going to actually cut and paste those into this sheet here. Let's start with the income statement. So we'll go over here to the income statement, and I'll try to keep them in this row with the wide columns here. And we'll use June 30th, 2020 as our base year, let's say. So we go copy. And notice I'm copying the names of the accounts as well as the numbers for June 30th, 2020. And we'll put that right here. Now here's what I'm going to do. I'm going to actually write June 30th, 2020 right there. And I'm going to write June 30th, 2021. That year's a long way off. 2021 right there. And then we'll go out 5 years because we're going to have a two-stage model again. 5-year super growth period and then a terminal growth period. Okay, so there's our 5 years. And I'm going to move these numbers. The amounts that we were for June 30th, 2020. I'm going to move those, just cut and paste those right here. Okay, and to the left of the June 30th, 2020 column, I'm going to put percentages because I'm going to make an assumption of this that a lot of the items, especially expenses, as well as a lot of working capital items, and even net property, plant, equipment, I'm going to assume they grow as a percentage of their sales. Now, over time, that would obviously change. If let's say you became more productive, you would use the same equipment or to produce more sales, so that would change relation. But these things change over time. But to build this initial model, let's assume that things are linear. Okay, so here's what I'm going to do is revenue. Everything's going to be as a percentage of revenue. So I'm going to go equals for revenue is equal to itself. So revenue divided by itself. Okay, and in the bottom here, in the denominator of this ratio, I'm going to put dollar signs. 1 minute here, dollar sign right there, because I'm going to compute everything, not earnings per share, but everything as a percentage of revenue. Okay, and then I'm just going to go reformat this here, make it look a little bit more official. Probably go out 3 there, that's okay. Okay, so there's their gross margin, by the way. That's really their gross margin percentage. Gross margin divided by revenue. So Microsoft's making 70%. I wonder what Apple's gross margin is. I still haven't compared. Anyway, so we'll start with that. Now let's go down. So that's the income statement. So let's put the word income statement there. And all this is, I'll just put MSFT here. Microsoft. All this is Microsoft. And probably insert a line there just to make it look better. Okay. And do that. Okay, and now, next I'm going to put balance sheet in here. And I'm going to do the same thing. I'm going to copy the balance sheet, and I might as well copy down the dates here too. Copy the balance sheet over. Balance sheet's a little more complicated. So I'll go ahead and copy the balance sheet there too, same years. And I'm also going to put a percentage here because I'm going to assume in these, I'm not going to assume that all items are percentage of sales, but a lot of them, and even if they aren't a percentage of sales, it's a nice number to have. Okay, so let me go over, and I'm going to go ahead to the balance sheet here, and I'm going to copy the names of the items and their 2020 amounts. Okay, go from there. Okay. And go to full valuation, and I will copy those there. Okay. And I'm going to go ahead and move the amounts, make sure I got everything, just like I did. Move the amounts over to the date column. Okay, and then I'm going to compute the percentages of the balance sheet items as a percentage of sales too. And that would be true especially for the current items like cash and short-term investments. I'm not sure about. Probably there'd be some relationship, not as much, but accounts receivable certainly, inventory certainly. Those things are related to sales, and probably vendor accounts payable. And I'm not sure about current portion of long-term debt, but anyway, so the current items. But I'm just going to make that a sum. I don't know if I'm going to assume that in the next video, but I always like to pick off the or know how much each item is as a percent of sales. Just knowing that number can give you some information. But anyway, so let's go ahead, and the only thing I've got to do is copy this formula down to all these balance sheet amounts because I froze the denominator. And it should give me, it'll give me the percentages. Okay. And so far, so cash is 6.2% of sales, short-term investments are 31% of sales. That would be, short-term investments are probably a non-operating item. So, and that'll be something we study after we do this. We'll hit the part of the chapter, we'll hit part of chapter 2, which is, or whatever, which is operating and non-operating items. But that probably would, if they're non-operating, they're probably less likely to have a relationship with sales. But we'll keep that assumption for now. Okay. And anyway, so let's go ahead and see if we can build pro forma statements based on my simplified assumptions here for the entire income statement there, and then down beneath for the entire balance sheet. Now this is pretty easy. Now there's a golden rule. I'm going to put the golden rule here is, well, first of all, I'm going to show you an equation, and then I will give you the golden rule. Okay, so first of all, from our from the analyst estimates, we got the assumption that that sales are going to grow at 16.7%, and that we're going to assume everything is linear, so income probably grow at 16.7% too. We'll at least make that initial assumption. Okay, so let's grow revenue at 16.7%. So we're going to take 143,050, 143,015, and multiply that times 1 plus our super growth rate, because these 5 years are the super growth period. And we get whatever that number, 167,000 more or less. And we're going to freeze those two things right there. We're going to freeze the growth rate so that we can grow sales at that amount right there. Okay, so I guess we'll end up at $265 billion of sales in a few years. Microsoft will. Apple already does that, more. Anyway, so now what we're going to do is certain items on the income statement are what I call line items. They're just expenses. Other things are what you would call a subtotal. Gross margin is a subtotal. And if you read down, R&D, your operating income is going to be a subtotal. Your income before taxes is going to be a subtotal. And your net income are going to be a subtotal. So certain of these things are line items like expenses, but income items and gross margin are subtotals. And the rule when making pro formas is if something is a subtotal, calculate it as a subtotal, and if something is a line item, calculate it as a percentage of sales. Okay, so here's what I'm going to do. This is key. This is key, and I'm going to put in big, bold letters. And if I knew how to make them flash, I would. Anyway, so here's what I'm going to do. I'm going to go ahead and copy and give you a formula which basically takes that number there, the sales number for the year end 2021, and multiplies it times 30, that number there, which should give you your cost of revenue for that year. Okay, and so here's the formula, and the important part of this is that I'm going to put the dollar sign. I'm going to strategically locate the dollar signs so where I can copy both to the right and down without changing the formula. Okay, so anyway, let's start with this is E. We'll do this again. Make sure I got the right thing right there. This is sales times, it's very easy, times this year's percentage. So every year, cost of sales, they call it cost of revenue, cost of sales, something. Cost of revenue is going to be 32% of sales. Now, the easiest way, there's a formula where you can just put in the formula and copy this to the right and then copy down when it's not a subtotal. Okay, so and that formula is the formula I just gave you, but put a dollar sign in the 14 and put a dollar sign in front of that C right there. And I'm going to call it base formula. Okay, and it's just the base formula that's buried in there. Now, I can take this formula and copy it down, and let's prove that it works, because everything on the cost of revenue line should be 32% of sales. So if I take this 85 billion for last year and divide by sales for that year, it gives me 32%. Okay, so the base formula works, and so here's what you're going to do. for any line item, which you assume is going to be a percentage of sales, you're going to use the base formula. And for any line item which is a subtotal, you're going to actually just calculate the subtotal, which means you're going to actually have to know how to read the financial statements. Anyway, so those are the inputs so far. I'm going to stop here. I'm going to call this particular video setup, because we are set up to fairly easily in the next video with our base formula and all the data we have here is to make our pro forma income statement and balance sheet. In the third video, I will make a pro forma statement of cash flows, which I don't do in the MBA class. I do it here. And then finally, we'll finish our evaluation, probably in the last two videos, because there's a couple things we have to do for fixed assets. Anyway, so let's stop there. I'll put this up in the next video. I'm going to finish the pro forma income statement and pro forma balance sheet. Thank you very much.